It happens in an instant. The calm hum of the trading floor shatters. Suddenly, everyone is shouting. Screens that were green just moments ago are now flashing violent shades of red. Phones are ringing off the hook. Traders are scrambling, desperate to execute sell orders before the numbers drop any further. Within a matter of hours, billions of dollars of wealth simply evaporate. Fortunes built over decades vanish, leaving nothing behind but panicked headlines and empty accounts. When you see a chart like this, a jagged red line falling straight down into the dark, you have to ask, what actually causes a stock market to crash? We surround Wall Street with supercomputers and complex algorithms. We treat it like a precise mathematical machine. But at its core, a market collapse is driven by something completely unpredictable: us. Looking at this modern, organized trading floor, the system seems perfectly rational. Stripped of all the financial jargon, the stock market is just a marketplace, a grocery store. But instead of buying apples, you are buying pieces of real businesses. When you buy a share of stock, you are buying a tiny slice of that company's future profits. If the company makes money, you make money. This animation shows the basic math of the market. It's a simple scale of supply and demand. When a company builds a great product, more people want to own a piece of it. Demand tilts the scale, and the price of the stock goes up. The foundation is entirely logical. But this system has a built-in vulnerability. The levers of supply and demand are pulled by human beings, and humans feel fear. That fear is the catalyst for every collapse. When investors get spooked by a bad earnings report, a geopolitical conflict, or an unexpected disaster, they stop looking at what a company is actually worth. They just want their money out. They start selling. In this network diagram, a single point of panic flashes red. One investor sells. The person next to them gets nervous and sells too. The infection accelerates. Financial news broadcasts the dropping prices. Bold headlines scream about a sell-off, pumping anxiety into living rooms worldwide. Today, social media algorithms pour gasoline on the fire. Rumors and terrifying predictions ricochet across platforms in seconds, creating a massive echo chamber. The fear becomes inescapable, triggering a blind stampede for the exits. The reality is, a market crash is a psychological contagion. The actual companies might be perfectly healthy, but the collective fear of losing money becomes a self-fulfilling prophecy. The panic itself destroys the wealth. We like to think our modern financial system is immune to this kind of raw emotion, but the blueprints for this destruction have repeated themselves for a century. Look at this crowd gathered on Wall Street in 1929. The initial spark was a rapid expansion of debt, but the result was pure human panic. People physically rushed the banks, desperate to pull their cash out as the market fell to pieces. By Black Monday in 1987, we had traded paper tickets for computer screens, but the reaction was identical. Traders panicked, the systems were overwhelmed by sell orders, and the Dow Jones dropped by over 20% in a single day. In 2008, the trigger was a collapse in the housing market and bad mortgages. 12 years later, in early 2020, it was a global pandemic that locked down the economy. Two wildly different events. The math changes. The technology advances. The specific catalyst is totally irrelevant. The only constant in every single crash is contagious human panic. When the dust settles on the trading floor, the real problem begins. A market freeze never stays contained inside the walls of the stock exchange. As stock prices plummet, companies lose their funding. A business that was planning to build a new factory or launch a new product suddenly has to slam on the brakes. To survive the financial winter, they have to aggressively cut costs, and the first cost they cut is payroll. That abstract red line on a Wall Street monitor translates directly into closed factories, canceled contracts, and everyday people losing their jobs. A failure of the market becomes a crisis of livelihood. Yet, when the market bleeds, a specific group of people do not panic. The most successful investors in the world look at the chaos and they simply step away. They survive the drop by refusing to make emotional decisions. They zoom out and look at the timeline in decades, not days. They know that selling at the bottom of a panic only locks in the loss. They also use a strategy shown in this animation: diversification. Instead of holding one solid block of risk, they break their money up across different industries and assets. Now, for educational context, this isn't financial advice. All investing carries risk. But mathematically, spreading your bets creates a shield against localized collapses. Surviving a crash requires a shift in perspective. You have to recognize that the falling numbers are not an apocalyptic end. They are just a severe but temporary storm. If you look back at every major collapse over the last 100 years, a clear pattern emerges. The market is cyclical. The panic eventually burns out. Rational minds step back in, and the system slowly rebuilds its value. Every market crash feels like the end, until history writes the next chapter. Next episode, who really owns the biggest companies in the world?